Welcome to our CFP Exam Prep podcast. Today we're diving deep into profit sharing plans, specifically focusing on their contribution characteristics and common exam traps. Let's break down the core concept of profit sharing plans. These are qualified retirement plans, where employers make contributions to employees' retirement accounts based on company profits. A key point that often appears on the exam is that contributions must be substantial and recurring, but they're completely discretionary. Understanding the term substantial and recurring is crucial. The IRS doesn't provide a specific definition of substantial, but generally, contributions should be significant enough to demonstrate a genuine retirement program rather than just a tax avoidance scheme. Many candidates misinterpret this to mean annual contributions are mandatory. They're not. You can have years with zero contributions, but over time, the pattern should show meaningful funding. Now let's talk about contribution limits, which is a frequent exam topic. For 2023, the maximum annual contribution limit is the lesser of 100% of compensation, or $66,000. Here's where candidates often make mistakes. They forget that this limit includes both employer contributions and employee deferrals if the plan permits them. For example, if an employee makes a $20,500 salary deferral, the maximum profit-sharing contribution would be $45,500, not the full $66,000. The allocation formula is another critical concept. Most plans use a comp-to-comp method. Here's a practical example. If a company has $100,000 to contribute and total eligible compensation is $1,000, each participant would receive 10% of their compensation. If an employee earns $50,000, their allocation would be $5,000. Exam questions love to test your ability to calculate these allocations. Common exam mistakes include confusing profit-sharing plans with money purchase plans. Remember, profit-sharing contributions are discretionary, while money purchase plans require fixed annual contributions. Another frequent error is misunderstanding the substantial and recurring requirement. Questions might present scenarios where a company makes sporadic, tiny contributions and ask if this meets requirements. The answer is typically no. Integration with Social Security is another tricky area. Profit-sharing plans can be integrated, allowing higher contribution percentages for compensation above the Social Security wage base. The exam might present integrated allocation calculations to test your understanding of permitted disparity rules. Here's a pro tip for exam success. When you see a profit-sharing question, immediately identify whether it's testing contribution limits, allocation methods, or qualification requirements. This helps you focus on the relevant rules and avoid getting distracted by irrelevant information. The vesting schedule is another important aspect. Unlike safe harbor 401k contributions, profit-sharing contributions can use a vesting schedule. The exam might test your knowledge of maximum vesting schedules, either cliff vesting up to 3 years or graduated vesting up to 6 years. Remember these key points. Contributions are discretionary but must be substantial and recurring over time. Maximum annual limits apply to combined employer and employee contributions. Allocation methods must be clearly defined and consistently applied. And finally, integration with Social Security can affect contribution percentages for higher paid employees. Keep these concepts clear and distinct in your mind, and you'll be well prepared for profit-sharing questions on the CFP exam.